Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Constellation Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices, and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only. Manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context.
So imagine you've just spent, $5 billion building this massive state-of-the-art artificial intelligence data center.
Right.
You filled it with the most advanced chips on Earth, you've hired the best engineers, and then you realize you don't actually have enough electricity to turn the servers on.
Oh, wow. Yeah, that is literally the exact nightmare keeping tech CEOs awake right now.
Exactly. When you look at long-term wealth generation today, you simply cannot ignore the AI supercycle. But here's the reality check. AI doesn't run on air. It runs on electricity. Massive, unprecedented amounts of power.
And they can't just, plug these massive facilities into the standard grid and hope for the best. Data centers need reliable, carbon-free baseload power.
Baseload, yeah.
Which means power that runs 24/7 without fail.
Right.
Wind and solar are fantastic, obviously, but they're intermittent.
Right, the sun goes down.
Exactly. You can't have a multi-billion-dollar tech facility go offline just because it's cloudy or, the wind stopped blowing.
Which is exactly where Constellation Energy enters the chat. They operate the largest competitive nuclear fleet in the United States. We're talking about roughly 22 gigawatts of capacity, which is just massive.
Yeah, it's huge.
And what's fascinating here is their evolution. They're actively shifting from being just a traditional commodity price taker where you just dump power into the grid at whatever the going wholesale rate is, into an irreplaceable strategic infrastructure partner for the biggest tech hyperscalers in the world.
You can almost think of them as setting up a toll booth on the AI highway.
Oh, I like that analogy.
Yeah, because every major tech company building a new data center eventually has to drive through that toll booth to get the firm, reliable power they need. But as an investor, you really have to look at the cost of building that toll booth.
Right, the debt.
Exactly. They recently made this massive $16.4 billion acquisition of Calpine, and they took on another $12.7 billion in assumed debt to do it. That's a staggering amount of capital to deploy all at once.
It's a massive bet on the future, no doubt.
But you have to ask, was that expansion absolutely necessary to secure their dominance? Or is it sort of a costly overreach that puts the balance sheet at risk just to maintain their market position?
Well, to figure out if that debt is going to crush them, we have to look under the hood at how their cash flow is actually performing today.
Now let's look at the fundamentals.
And the step change in revenue here is, well, it's hard to overstate. It's being heavily driven by that Calpine integration and this insatiable demand for clean energy.
The numbers are pretty wild.
They really are. If you look at the first quarter of 2026, revenue literally doubled to $11.1 billion. That's a 64% increase year over year.
Let's just pause on that for a second, because doubling revenue for a company of this size is almost unheard of.
Exactly. And it's flowing right to the bottom line, too. GAAP net income absolutely skyrocketed to $1.6 billion.
Up from just $118 million a year prior, right?
Yeah. And adjusted operating earnings per share hit $2.74. They are generating a mountain of cash. Free cash flow is projected at $8.4 billion across 2026 and 2027.
Which is incredible.
And then it jumps to between $11.5 and $13 billion for 2028 and 2029.
The sheer scale of those numbers is impressive. But, what stands out to me is the quality of those earnings. They currently hold a Piotrowski F score of 7 out of 9.
That's a really strong score.
It is. If you're not familiar, think of the Piotrowski score as a kind of financial lie detector test. It looks at 9 different areas of a company's accounting to see if their reported profits are backed by actual cash in the bank or if they're just using clever accounting tricks.
Right, paper profits.
Exactly. A 7 out of 9 essentially tells you that this net income is highly legitimate. It's backed by hard cash inflows.
And they're using that cash intelligently to manage the debt you mentioned earlier. After the massive Calpine deal, they didn't just sit on their hands, they executed a $5 billion divestiture of secondary gas assets to LS Power.
Which was a smart move.
Very smart. It satisfied antitrust concerns, but it also immediately streamlined their focus and brought in a ton of capital. Their interest coverage ratio is sitting at a very healthy 6 times.
Meaning their earnings are 6 times higher than their interest payments.
Right, giving them a massive buffer to service that debt.
I hear that, but let's apply some practical skepticism here. In that first quarter, they posted an EBIT margin of 21%.
Which is high.
It is. And the bullish thesis relies heavily on the idea that the Calpine integration has structurally, permanently raised their profit margins. But energy markets are highly seasonal.
Very true.
So we have to wonder if that 21% is actually a new structural floor, or if it was just a temporary spike driven by a really favorable seasonal load and pricing environment. Because if it's just seasonally...
Those margins are going to normalize downward very quickly.
Exactly.
You're right to be skeptical about seasonality, but look at how management is actually behaving. You don't spend $335 million on stock buybacks if you think your margins are about to fall off a cliff.
That's a fair point.
The board explicitly called the current stock price a bargain. When a company tells you their stock is cheap and then drops hundreds of millions to back it up, you pay attention.
Yeah. Actions speak louder than words.
Right. And we'll know soon enough if those margins hold, based on a few massive events on the horizon.
That brings us to the catalyst timeline.
Over the next 3 months, there are several imminent regulatory and earnings events that will dictate the entire trajectory of this stock.
It's a busy summer.
It really is. The massive one hits in June 2026. PJM, which operates the regional power grid, is scheduled to deliver its large load framework to FERC, the Federal Energy Regulator.
We really need to unpack why this matters so much, because this is all about colocation rules.
Colocation, right.
Right now, tech companies want to build their data centers directly next to Constellation's nuclear plants, literally co-locating them. Why? Because if you plug directly into the reactor, you completely bypass the regional power grid.
Which is huge.
Exactly. That means you avoid paying grid transmission fees, and you avoid the years-long wait list to get a grid connection. But FERC has to decide if that's legally allowed or if it unfairly raises prices for everyday consumers.
Exactly. And a favorable ruling there will essentially unlock a massive backlog of data center contracts. I mean, there is currently a 5,000 megawatt queue sitting in PJM waiting for approval.
5,000 megawatts, that's insane.
It's staggering. The CEO has explicitly stated that hyperscaler agreements are paused but not canceled. These tech giants are just waiting for the regulatory ink to dry.
Just waiting for the green light.
Right. Once those rules are set, we are anticipating an absolute flood of multi-gigawatt deals. On a macro level, hyperscaler spending is projected to run 75% higher than last year. The demand is there.
The demand is there, absolutely. But we also have to look at the supply side, specifically the supply of the stock itself. June 30th, 2026 brings a major technical event.
The lockup expiry.
Yes, the Calpine lockup expiry.
Explain how that works for someone holding the stock right now.
Sure. So when Constellation acquired Calpine, they likely issued shares to Calpine's owners with a lockup agreement, meaning they weren't allowed to sell those shares for a certain period.
To prevent them from just dumping it all at once.
Exactly. But on June 30th, that lockup expires, introducing a potential supply overhang of 25 million shares hitting the open market.
Wow, 25 million.
Yeah. Now, management has claimed that they have the flexibility to absorb those shares, perhaps through institutional placement or more buybacks, but they haven't made a firm, binding commitment to do so.
So that's a real short-term supply risk.
Very much so. Furthermore, looking into July and August, when the second quarter earnings drop, the entire market is going to put a magnifying glass on those margins. If they fail to hold above 15%, it validates the concern that the first quarter was just a seasonal fluke.
Now let's pivot to the chart.
If you're holding this stock right now, you're probably feeling some intense whiplash.
Oh, for sure.
The price structure has been a severe, highly volatile correction. Year to date, the stock has suffered a 27% drop, and it is sitting 28% below its 52-week high.
Ouch.
Yeah, trading roughly in the $267 to $300 range. We recently saw a violent 6% single-day drop that completely shook out momentum traders, which was triggered just by an analyst valuation cut.
The volatility is just intense right now.
It really is. When you look at the risk profile, the annualized volatility is a staggering 56.3%, with a max drawdown of nearly 39%.
That is not a normal utility stock.
Not at all. You have to understand, it is currently trading with the beta of a highly speculative tech stock. Beta measures how wildly a stock swings compared to the broader market. Right now, this is not trading like a safe, sleepy, dividend-paying utility. It's trading with the mood swings of a Silicon Valley startup.
You're not wrong about the mood swings. But, from a structural perspective, what you were looking at on the chart is a classic basing pattern.
The basing pattern.
Yeah, the downside risk is actively being digested by the market. Because the stock price dropped while their earnings skyrocketed, the forward PE multiple, the price-to-earnings ratio has compressed massively. It's fallen from 40 times earnings down to 25 times earnings.
Meaning it's gotten significantly cheaper relative to the actual money it makes.
Exactly. And that massive PE compression makes this an incredible buy-the-dip opportunity for the long haul. You're getting a dominant infrastructure asset at a steep discount. Intrinsic fair value estimates for this company are sitting comfortably between $370 and $399. And some of the more rigorous cash flow models point as high as $569.
It's a huge upside.
It is. The underlying value is there. The price action is just temporarily disconnected due to the broader market anxiety.
So what does market sentiment look like?
Well, we are seeing a stark divergence right now between what the public thinks and what the insiders are doing.
Which is always interesting.
Yeah. The retail and analyst mood is mixed to outright bearish, mostly because of those looming regulatory hurdles with the FERC collocation rules and, of course, the visual pain of that sharp year-to-date sell-off we just talked about.
Yeah, it's hard to be bullish when you open your portfolio and just see a sea of red.
Right, it's a tough pill to swallow.
Yeah.
But if you look past the screen and look at the underlying business news, it is incredibly bullish.
What kind of news?
Well, they're commissioning the Pistoria Solar Project, the Pinot Creek Energy Center, and they just secured a massive 380-megawatt agreement with a Phase 2 attached with data center developer Cyberstone.
Oh, wow. So they are actually signing deals.
The business is executing flawlessly. That's why management buying back $335 million in stock at these levels is the ultimate institutional signal. It's a clear statement of confidence against the short-term market noise.
It is a strong signal, I'll give you that. But you have to put yourself in the shoes of a conservative institutional fund manager.
Okay.
Yes, the PE compressed to 25, but Constellation still carries a premium multiple compared to legacy utility peers. If you're managing a traditional utility fund, that premium is a psychological roadblock.
I can see that.
You see the extreme volatility, you see the regulatory waiting game with FERC, and you hesitate. You have to wonder if the broader market is just re-rating the stock back down to match traditional, slower growth power companies.
Now let's talk about the risks.
The bear case here is built on three main pillars: regulatory price caps, margin reversion, and the long-tail costs of nuclear power.
Okay, let's break those down.
First, the regulatory environment. PJM and FERC have implemented a price collar on upcoming energy auctions. They have capped the price at $325 per megawatt day with a floor at $175.
Right. So think of a price collar like rent control for the power grid.
Yeah.
It's designed to prevent consumer electricity prices from spiking too high, which obviously protects the public.
Right.
But as an investor, rent control explicitly limits your upside potential in a tight market. If energy becomes scarce and highly valuable, Constellation's profits are capped.
Exactly. And if the FERC collocation rules come down adversely, meaning they don't let data centers bypass the grid, it could explicitly limit the green premium Constellation expects to extract from big tech.
Yeah, that's a real threat.
Secondly, there's that risk of margin reversion we discussed. Operating income could easily compress back toward the $580 million to $950 million range we saw in late 2025 if that first quarter really was just seasonal.
Which would hurt the valuation.
A lot. Finally, we can't ignore the structural reality they operate an aging nuclear fleet. The long-term regulatory and decommissioning costs associated with shutting down old nuclear reactors are astronomically high. That remains a permanent structural headwind that will eventually come due.
Those are the exact risks keeping the bears fed right now. but you have to look at the structural mitigations Constellation has actively put in place.
What do you mean?
Worried about adverse collocation rules and spot market price collars. Constellation is actively bypassing the wholesale spot market entirely for a huge chunk of their business. They are signing 20-year long-dated agreements directly with companies like Microsoft and Meta.
Oh, wow. 20 years.
Yeah. Those contracts lock in predictable, high-margin revenue for 2 decades, completely regardless of what the daily spot market or the price collar is doing.
That's a fair point.
Yeah.
I mean, a 20-year contract is the ultimate hedge against daily market chaos.
Precisely. Furthermore, the Inflation Reduction Act introduced nuclear production tax credits.
The PTCs, right.
Exactly. These credits provide a rock-solid structural floor against price volatility. The government is essentially guaranteeing a minimum return for clean nuclear power. So the company is actively insulating its core business from the exact merchant margin compression that the bears are worried about.
So with everything on the table, what's the final verdict?
Factoring in the irreplaceable nature of their nuclear baseload, the massive cash generation, and the impending wave of hyperscaler demand, the research points to a bullish score of 8 out of 10.
An 8 out of 10.
Yeah. The fundamental transition happening here from a standard merchant utility into a highly contracted AI infrastructure platform is profound.
It is profound, but it is crucial to understand that this is a multi-year hold. We are looking at a 1 to 3 year horizon here.
Definitely not a day trade.
No. The transition we are discussing will take several quarters to fully play out. Investors need to be patient, especially as we wait for those regulatory cues to clear and for those PJM conversions to actually materialize into firm revenue on the balance sheet.
Right.
It all comes back to that toll booth on the AI highway. The traffic is absolutely coming, but the construction of the road takes time. And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to $10 K versus with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.